Hi there, this is Bruce at Fleet Capital Management. It is Friday evening, the 6th of October, 2023. I want to take you through some slides of the market. We had a huge reversal today, which could be the beginning of something good, but we'll wait, we'll be patient, we'll take a look at the charts, what they say. But I want to show you a couple other slides first, so you can start to understand even more about what makes the market move. So before we get started, we just need to say the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell a security. As always, I'm always available to you. Bruce at fleetcapitalmanagement.com. Homepage of our website, 2 buttons. This will take you to our most current video, and the top one will put you on my calendar. Please use this if you want to talk and get a one-on-one so that we can get on the calendar and iron out any ideas you have, questions you have about the market, things like that. Just what I'm saying is feel free to use this button. A few days ago, I sent you in a morning email, which I don't know if you read or not, this fear and greed index, and I suggested that this is where market bottoms come to die. Whenever the crowd, which is considered retail investors, are in extreme fear, we tend to be at or very, very close to a bottom in the market. Conversely, when retail investors have an emotion of extreme greed, this is easy, let's mortgage the house and put all the money in the market, that generally signifies a market top. So the reason I wasn't real nervous is because the crowd was, and the crowd is almost always wrong. You can also look down here. This is where it was. I believe this was on Monday. But whenever this index gets below, let's call it the 25 line, and we're significantly below that, and we were significantly below that once before, but it just that does look like the bottom. Okay, that's why I included that. I also wanted to talk about what makes the markets go up and down, and I was looking for a graphic that might help you understand that, because there were some questions this morning. If the jobs market is so great and the economy is so great, why is the stock market going down? And that is the age-old question, and it's a fabulous question. So let's talk about that a little bit. I found this chart on the internet, of course. I think it was Investopedia that made this. They're usually really, really good. In this case, they were really, really, really bad. This is called factors that cause the market to go up. Granted, there are tons of factors, hundreds of factors that are all in the mix of the market, but it's not indicators and supply and demand and changes and disaster. It's not wars. I can show you wars where the market went through the roof and others where they went down. I think all of these things are very minor, minimal impact factors on the market. So I think Investopedia, at least in this case, did a really poor job. What really drives the market is concerns over inflation and deflation, which is directly related to government fiscal and monetary policy. And these two things are really how much in taxes we pay and what the interest rates are. So let me prove a little bit of that to you. First, this morning, right after the jobs report came out, and again, it was exceedingly strong. This was written, it said stocks initially tumbled after the report showed U.S. employers added nearly twice as many jobs last month as economists expected. The strength, and here's the key, the strength of the job market raised worries that a too hot job market could keep upward pressure on inflation. And inflation is related directly to what? Interest rates, which in turn could push the Federal Reserve to keep interest rates higher than investors want. So that was the initial shock, if you will, after that jobs report posted, and it posted at 8:30 a.m. New York time. That's when the news embargo overnight is lifted. That's why that's an important time for me when I'm looking at the markets. It's an hour before the markets open. But the point is, the initial shock was that interest rates would stay higher. Then what happened? Because we had a huge rally for much of the day today. What happened was cooler heads prevailed, and they realized that the wage inflation was very, very low. Wages have pretty much stopped rising. They were rising significantly. And then also that if the Fed does raise, they're probably at the very end of their raising. So, there's always a shock. There's always a shock. We don't trade around news, but then you start to think through it. Now, if jobs were strong, inflation was strong, I meant to say wage inflation was strong. If all of that was, the market would have not risen today. And then finally, to kind of prove this point, we're looking at 10-year Treasury interest rates versus the S&P. I drew this black line on here because prior to that, we were in a hyperinflationary environment, which is extremely rare. And you can see that the market kind of did nothing during that time. But let's just forget that, because that was an outlier. If you look at this, focus on this blue line, you will see, it's very easy to see, what's the trend here? Well, the trend is down. The trend is down. Interest rates, Treasury interest rates, the trend is down. And then this orange line is the S&P 500. The trend, it goes from the bottom left to the top right. Are there some pullbacks in that area? Yes, there absolutely are, because like I said, there are other things. Here was the Great Recession of 2008. This was kind of the housing bubble and the mortgage bubble. And then after the tech run, we had a bit of a pullback recession early 2000s. So other things will happen. But in general, if you were to just draw an arrow on this green line, you would see that it rises. And if you drew an arrow on this blue line, interest rates, that it falls. So that's why these two things are by far the most important aspects. We're looking at inflation. And whenever you hear inflation, it's interest rates. And like I have told many of you on many occasions, when it comes to the economy, good news is bad news for the market, and bad news is good news for the market. Now, that's a generality. Good news meaning strong jobs, strong housing prices, strong, the economy is rolling, the consumers are spending a lot of money. That sounds great. The stock market should be rolling. No, the stock market goes down. Why? Because that strong news on the economy creates in the Fed's mind concerns over inflation. And what will they do to combat that? They will increase interest rates. Does that make sense? If we have weakness in economics that are posted, job growth is slowing, wage inflation is slowing, housing prices are slowing, all these things that sound so negative. Well, why does the market go up? The market goes up because then the Fed is concerned with deflation or recession. And what will they do with their policy? They will start to lower interest rates. Lower interest rates. And that will cause the market to go up. So I hope this helps. Let's go over to the charts and take a look. First, here's our matrix of our analysis. This is the shorter term. The D is day. And you can see we've been in the red on the real short term. I thought today might turn it up, but it didn't. It got a little close, but it didn't. On the weekly, we have a split. We got a down and an up, and I'll show you all this on the charts. And then on our bear market avoidance indicators, the most important one is this one, which is still firmly in the green. This one is in a cautious area, and I think that's going to change sometime soon as well. Okay, let me close that out. Let's go over to these charts. Here's the GNG, the go, no go charts that I use, weekly on the left, daily on the right. What you're going to see is the 20 moving average, which is that blue, and I've lightened that up. Hopefully that makes it a little bit easier to see. But the 20-day crossed below the 50-day, and that is what signifies, in my mind, a correction rather than a pullback. And the correction started, and nobody likes to see this, but I just kept us primarily in cash, which is a good thing. Cash is good when this is what your market looks like. I wasn't real worried for two reasons. One, seasonality. We're coming into a very strong season of the stock market. And two, I could start to see that we were holding above the 200-day moving average. And that does tend to act as an area of support. Doesn't mean it can't go through it briefly and come back up. but this is more normal, and I saw that support. The market opened, you can't really see it, but way down here, it dropped early in the morning, and then it zoomed up and closed really close to its high. That's a very, very strong signal. I like that a lot. So the 20 is below the 50, and that's why we had a caution or a yellow on that particular box. Over here on the weekly side, this is critically important that the 10-week, yes, it's been falling, but it's still above the 20-week moving average. If it crosses below like it did right here, that signifies a bear market. Just no ifs, ands, or buts. It's a bear market. And when it crosses back up, we're no longer in a bear market. So yeah, this is going down. If we had a few more weeks that were really weak, it could drag this down, but I don't see that happening at all. Okay, let's go over to our other chart. This is the S&P 500. Just for a moment, I'm going to take all of the indicators off because I like to show you that without indicators, you can't tell where you are in the world. Simone Biles, the phenomenal gymnast, when she dropped out of the Olympics, she said she got a case of what's called the twisties. Gymnasts get this, fighter pilots get this, and what that means is for some reason their brain isn't allowing them to understand where their body is in relation to the ground or in space. So if you don't always know where you are, it becomes very dangerous to be a gymnast or a fighter pilot. So without these indicators, we really don't know where we are. We know we had a good day today and it came down, but there's nothing to help us with a guide. So moving averages, here we can see that we got support on the 200-day. We can see that the 8-day started to turn back up. I really want to see that get above these two lines as well, and that could happen very quickly, just like it did down here. It took a few days, but then it crossed back up. So we're still in a little bit of a cautious mode here. If I put on the hull, which is a very fast moving average, it's still red, but that could turn up very quickly. If I put on our linear regression, you can see, yeah, we closed below the linear regression, which we don't want to do, but now we're firmly back in because we closed up here. So it kind of gives us an idea of, between these two blue lines, which are 2 standard deviations above and 2 standard deviations below, is considered 98% normal, meaning 98% of prices should fall between those lines. If it goes below, we start to worry because it could just completely break down. But I saw this 200-day moving average below it, the red, and that gave me a fair amount of confidence. If we put the super trend back on, I use this. These are the ATR dots. I use this to help me with stop management. We're still below. They're still red up here. So there's still some caution. We're going to see what next week brings us. I will tell you that this red line, which is the directional indicator, is falling aggressively, and the green line is coming up aggressively. I'd love to see those two cross. They crossed here to go the wrong way, but I'd love to see those cross again. We're just not there yet, but we're getting close. We are getting close. If I look at a couple of our stocks, let's go to NVIDIA. NVIDIA, I had a stop. The white dashed line is a stop. Why did I put it there? Well, I had put it there because that was a pretty dramatic swing low. And normally what that means is there are some buy orders under here. And it came pretty close. I did not want to get stopped out of NVIDIA, but rules are rules. It came pretty close, but it just didn't hit it. So we very carefully select areas of stop management, trying to stay in. And hopefully this is just going to continue to ride back up. OC, another stock that we continue to hold. Man, it has been so close to our stop, but it's an appropriate stop. I never, ever, ever, ever move stops lower. Like it looks like it's going to hit it, I won't move the stop lower. That's a very foolish thing to do. This was our entry point. This was our initial stop, and we just keep raising it. So hopefully that's going to run back up. Bitcoin has been showing some strength as well for those of you who hold Bitcoin with me, and we'll talk a little bit more about that on another video. The Qs, which is the NASDAQ, again, above the bottom of the linear regression. If you look right here, that red hull, it almost looks like one more day is going to turn that up. And I think one more positive day will bring that 8-day. So we're getting close. We're not there yet, but we're getting close. Look at this true strength index getting ready to cross. I want to see it cross the blue over the red, and I also want to see it above the zero. That would show me a lot of strength. So not to keep you any longer, I hope this helped you understand some of the reasons why good news in the economy can sometimes make the markets go lower. And also that the really one of the singular most important things in the stock market over the long term is interest rates and inflation. So that's why we watch those very, very closely, and we've been talking about them for a long time. So that's a story. If you have any questions, I ran through this as quickly as I could, trying to respect your time. But if you have any questions, shoot me an email. Other than that, have a fabulous weekend, and I will talk with you next week. Hopefully, the markets, the indicators will start to firm up in the early part of next week so we can start adding a lot more securities to our portfolio. Okay, have a great weekend. Bye-bye.